what's going on, guys? Welcome back to Marriage, Money, and Mindset. We are your hosts. I'm Jared.
And I'm Alexis.
Welcome back. We're here for episode 20 of Marriage, Money, and Mindset. Hey, appreciate y'all. Let's get these announcements going. New subscribers, thank y'all. We just crossed over 250 subscribers. Appreciate y'all. Appreciate the existing subscribers for coming back, returning. If this is your first time watching us, please consider subscribing. Share this channel, like the channel, and also follow us on Instagram at Marriage, Money, and Mindset. Right. So, how you doing? You good?
I'm doing great.
That's good, man. I'm all good, man. You know, we back. We shot episode 19 last week. If y'all guys missed it, so this month we're going to dedicate to real estate. We're doing a 5-part series. So last week's episode was about the introduction to real estate investing, right? You know, we gave y'all a few pros and cons of what real estate investing actually is. And, you know, basically we want to break down each segment, focusing on, what real estate investing is, dissecting each step all the way up into buying your deal and how to scale, things of that nature, right? Mm-hmm. So today's episode is episode 20. And it's how to prepare. So how to prepare for real estate investing, guys, okay? So we want to give y'all some good information. We don't want to speed through it too fast, but again, we're going to do our best. So before we kick it off, we are not financial advisors, okay? So this is for educational purposes only.
Right.
Make sure you still do your research. Exactly. So we got that out the way, okay? So, of course, thanks y'all for watching last episode, of course, where we talked about the pros and cons in this asset class. And of course, what to consider before getting started in real estate. So let's dive in. So we're going to give y'all some steps, of course, to what to consider getting into real estate. 5 steps, to get prepared for investing in real estate. So let's start with step 1. Okay, I'm going to kick it off and I'll let you kick the second one off.
Okay.
So look, guys, step 1 on how to prepare for real estate investing is know that you want to invest in real estate, obviously, right? Mm-hmm. Okay, so not only know you want to invest in real estate, but know which type of real estate investing that you want to do, right? Okay, so for instance, with us, we decided on cash flow. I'm gonna give you the 2 types of real estate investing real quick. There's capital gains and there's cash flow. Okay, I'm gonna dissect which each one means real quick. Capital gains is gonna be you buy a property, you fix it, you flip it for a profit, you make a profit. Your profit is capital gains, right? You didn't hold it long. Typically a fix and flip, a successful fix and flip, you get in, get out as quickly as possible, right. Make your proceeds, and then you reinvest them, right? That's capital gains. Usually you pay a higher tax when you do that method. And then of course, cash flow, what we do, buy rental property, basically. Buy property for the long term, you keep it, you put tenants in it, you get a rental income. That's cash flow. So decide on what you want to invest or what type of real estate investing that you would like to do before you even get started, guys. Okay.
Your end goal.
Right.
If you're in it for short term versus long term. Exactly.
Right. Again, maybe you could do a mixture of both. That's something else you can consider, right? Maybe
some people start off with the short term, like they'll wholesale properties or they'll fix and flip just to get the capital to do buy and hold.
But ultimately, I think, guys, you do want to, in my opinion, again, this is my opinion, I think ultimately you want to try to get yourself in a position where you get cash flow, okay? Because that's really, in my opinion, the holy grail of real estate investing. Because think about it, with capital gains, once you sell the property, you make your profit, cool. Then what? If it's not enough for financial freedom, you got to do it all over again.
Right.
So whereas cash flow, you can scale that and keep compounding and growing your income to infinity if you want, right?
Yeah.
Okay, so that's step 1, guys. Let's talk about step 2. So once you've decided what type of real estate investing you want to do, majority of the time you have to, usually the next step is to decide on the entity structure. So let's talk about that.
Okay, so there's different structures that you can set your property up under. You can be a sole proprietor, which is owning the real estate in your own name. There are cons to that, though.
Right.
There's personal liability for debts, lawsuits, and other obligations related to the property.
Right.
The other type is partnerships. So getting in with a partner so that you guys split that liability. So you can share profit and liability. The third one is LLC or limited liability company. And that separates your personal name from your business. So basically, if somebody is trying to sue you, for example, they're suing the business name, the LLC. They're not suing you personally. And corporations, creating a corporation for real estate investing, providing long liability. I can't see this.
Hey man, do your thing. This, hey.
Strong liability protection. Okay, so that's corporations.
You got an S Corp, C Corp.
Yeah.
So first of all, guys, these entities, you got to decide what works for you, right? I'll just give y'all my personal opinion again. Sole proprietorship, you probably don't want to do. That's the worst, in my opinion. Keeping it in your personal name. As an investor, you personally don't want to own the real estate. You want an entity to own it, right? Next best option is probably going to be, or the first best option is probably going to be an LLC, limited liability company, right? That protects you, like she mentioned earlier, from litigation. Also for tax purposes, it's a pass-through entity. So you want to keep that separate. You personally don't want to own the real estate. You want to own and operate and manage the LLC that owns the real estate, okay? Right. And of course, real quick in layman's terms with S Corp, now this is where it gets a little bit more technical. We actually have an S Corporation. We started with an LLC, but we have an S Corp. Reason being is so as you scale and grow, your income reaches a certain level, guys, you can now convert your LLC into an S Corp or S Corporation. Now, S Corporation helps you with taxes from being taxed. It's basically providing you from being avoiding double taxation. So self-employment taxes is what you would have to pay outside of an S Corp. In an S Corp, you don't have to pay self-employment taxes. So this is getting deep into like accounting. Mm-hmm. So I would consult with an accountant to learn more about this type of setup, this entity. But just know, guys, you have to pick an entity. If you don't, and where can you go to set up an entity? So there's like places like LegalZoom. That's one place. We actually used or had assistance from our accountant who provided us with that service. Mm-hmm. But it's very important, guys. Pick an entity and preferably one that's going to suit you the best, right? So that's step 2, right? So step 3, let's talk about step 3. Once you've decided on which entity, now we have to set up, all your documents, your paperwork, your bank accounts, right? So first step is maybe setting up an EIN. EIN is an employee identification number. Mm-hmm. You can set that up with the irs.gov, and apply for your employee identification number. It's
basically your business's social.
Yeah, exactly.
Social security number.
Right. If you're sole proprietorship, you're going to use your social security. Using an LLC, you're going to use the EIN. So that's in kind of way explained in layman's terms. Of course, you want to get a business bank account set up. That's at your choice who you want to, provide that service for you, whether it be a bank or credit union, preferably a business account, guys. So that way you can have a ledger of your income expense coming out of that account and separated from your personal account, right?
Right.
And then, of course, let's talk about, the next step of it's still the same step in 3. You need to decide if you want to self-manage or use a property manager, right?
Oh, yeah.
So let's talk about that for a little bit. So you're going to have to, if you're going to go long-term route, which is buy and hold, somebody's going to have to, manage the day in, day out duties of the property, right? Mm-hmm. Again, guys, you can do these jobs yourself. Just know that,
as you scale, it may become harder to do those things yourself. So it may just be easier to pay the property management fee and let them take care of the legwork.
Yeah. There's pros and cons to both, I'll just back to making it personal for us. We didn't get in this business to create another job for ourselves. We got into this business to be investors, right? Meaning that we just want to purchase properties and delegate it to the professionals for a fee, and that's okay. And the thing about it is that's business. That's doing business, right? Us doing the job that the property manager does is creating a job for us. So if you got a problem with the management fee, maybe you need to think about scaling, right?
Yeah,
Grow
get more
your business,
properties.
and the fee will become irrelevant. That's my opinion.
And it's typically about 10% of your rent.
Yeah, 10% is typically what a property manager will usually charge you, right? And then just accounting for your expenses, included in your expenses. So, right. Okay, guys. Some more of step 3. Something else you may want to consider, of course, is having a strong reserves of cash or just access to capital. So, going in, you're going to think about it. You buy let's say you buy one door to start off, right? You're probably not going to have it occupied immediately. So there's probably going to be a time where you're going to be having to,
Make it ready.
Well, make ready, but also pay the expenses until you get it occupied. So, hey, there's a more, if you finance your property, there's a mortgage, there's principal and interest that needs to be paid monthly. There's insurance, there's taxes that you need to allocate for if you don't have an escrow. There's utilities, there's upkeep, right? So a strong reserves is going to help you weather that storm until you can get it cash flowing, get a tenant in place, and get some revenue flowing, right? So just have a strong reserves or access to capital when you start this business, right, guys? And then, of course, let's talk about due diligence on management companies if you're going to go that route, right? Make sure you examine or, not examine, but
kind of
interview.
Interview. Investigate.
Same. Yeah. Interview property managers in your area. Maybe even network with some people that use a certain property manager just to get an idea of what this particular management company is like.
Right. How they do their business.
How
long they've been in business.
Exactly. Some things
how many
to consider.
Properties they manage.
Right.
What areas do they manage?
Yeah.
Things like that.
Right. Yeah. And then just take a tour of their, facility if they allow you to. I mean, so this is still the things you want to think about, right?
Even though you get a property management company that you hire, you still have to manage that company.
That's really what it boils down to. I mean, you're going to end up managing the manager in most cases. So, again, guys, whatever route you do want to take is your preference. So just, do your due diligence if you're going to use a property manager. All right. Okay. Let's talk about step 4. Step 4 is learning your market. Okay. So, there's real estate markets across the nation. So some are a little bit more favorable to investors. Some are a little bit more favorable to the renters, right? So if you're in a market where, the landlord, it's a landlord friendly state. Okay, cool. So, but even deeper than that, we talk about state. Now we gotta, zoom in a little bit more into the cities we're in. So, if you're in Timbuktu and there's there's no population there.
Right. It's not growing. It's just dead out there.
There's no jobs, there's no stimulation. May not be the best market to invest in, right? You preferably want to target markets where there's jobs, where there's stimulation, the economy is growing. There's positive migration, not negative migration. People aren't leaving, people are coming, right?
Right.
Infrastructure is growing, the city is growing. So just think about that, because if people are somewhere, you're going to need to house them, right? So there you go. You want to learn your market, make sure there are people there, right? We're not going to touch on all 8 of these, man. This is too long.
Okay.
Yeah. Just know, guys, when you're analyzing your market, things to consider is, of course, location, maybe attend some real estate events and meetings, track the comparable sales and rental prices. That's important. Run comps, see what the rents are in your market, right? Just stay up to date with market news, evaluate the cycles, things of that nature, guys. So, we don't have to go that deep into it,
Yeah. Just know you don't necessarily have to invest in your backyard. So we live in Beaumont, Texas. All of our properties except one are in Beaumont. So it is possible for you to invest in other places. So just do your research wherever you want to invest.
Exactly, right. Yeah, man. So, and let's talk about the last step, which is calculating cash flow. Now check this out, guys. We're not gonna talk about cash flow today. We're gonna wait until the next episode, right? Reason being is because, again, I wanna go deep dive, taking our time, dissecting the numbers. And we're actually gonna share with y'all the very first deal that we've done as an example about cash flow, calculating cash flow, because it's just a great example for one. You know, it pays off. The education that I basically, took in prior to buying that deal paid dividends, right? Had I not done the research and due diligence that I did in educating myself, it's not to say that I probably wouldn't have came out the way I did on that first deal, but I guarantee you that had a lot to do with why that deal went the way it went, right?
Yeah.
So we're going to talk more about that deal, but also calculating cash flow, because you need to know the formula, guys. At the least, you need to know this formula. And once you know the formula, how to do it for 1 unit, you can do it for 100 units, 1,000 units. It's the same formula, right? The numbers don't lie. So we're going to talk more about that in the next episode. This episode, again, was just prepping you on things to consider after you've realized what type of investing in real estate you want to do. The mindset involved with prepping for that. And then, of course, going into the numbers, that's very important, because that's really what makes a deal, knowing the numbers, right? Anything else you want to add to what I just mentioned?
Do we want to mention any books?
Well, yeah, I mean, there's a book I recommend, The Millionaire Real Estate Investor by Gary Keller, which I think I have. I'll break it out for y'all next week, right? Yeah. That's a good book.
I'll link it.
Yeah, we'll put it in the link, right? We'll link it somewhere. I don't know how to do that. But anyway, that's a good book, guys, to get you started. That's like a manual to real estate investing. Eventually, we may work on one for y'all as well. Just stay with us and hang tight. We want to start writing some books as well. We got a few ideas for that. Yeah, man. So, but just know, guys, investing in real estate, I mean, like I said, it's a very lucrative way to earn income or passive income, and grow equity, grow your income. It's been great for us up until this point. We're about 6 years in investing in real estate. Yeah. So again, we have wisdom there, right? And we're wanting to share it with y'all. And for the ones who already invest in real estate, y'all can compound y'all's wisdom with what we know. And it's all about, that's what it's all about. If you have wisdom, share it, give it to someone else to empower them. And and we're all talking about mistakes as well that we made along the way. That way we can help mitigate your risk,
right?
So you don't make some of the same mistakes we may have made, right?
Yeah, shorten that learning curve.
That's what it's about. You know what I mean? So, hey guys, look, we appreciate y'all. We hungry, man. I'm gonna be honest with y'all. I'm keeping this short and sweet because I'm starving. I need to eat. Yeah. I need some energy. Yeah, she gotta feed me, man. So look, y'all come back next week. We're gonna be talking about cash flow, right? We're gonna calculate cash flow for y'all. We're gonna break out the easel, work the numbers. We're gonna show y'all one of our deals. We're gonna actually show y'all a form of appreciation with the first deal too, like how rapidly appreciation can occur. Right. So we're gonna talk more about that in the next episode, guys. So look, we appreciate y'all. Make sure you subscribe to the channel. Share this video, like it, comment. Let's get some comments, man. Come on, talk to us, guys. Don't be scared. You know what I'm saying? We could take negative comments too. Bring it.
I mean, you're helping other people as well whenever you ask questions in the comments or make comments down below. Other people are seeing that and they may not have had the courage to ask. So
just holler at us, man. If y'all want to, interact, let's interact, right?
Yeah.
So look, we're going to catch y'all next week. Y'all tune in for the next episode of Marriage, Money, and Mindset. Y'all take care.
Peace.